So you see plenty of Patagonia vest wearing bros getting rich from early investments in startups, and you think, I can do that. Any fool would have known Facebook would be wildly successful in 2011. If only you had access to invest in pre-IPO shares, it would be you driving a Lamborghini down your mansion's hallway or building rockets to take humanity to Mars. Well, today your luck is about to change. I'm going to tell you how you can invest in pre-IPO startups and become the next techno king. First, make sure you invest in that subscribe button and watch till the end because there are many nuances that are important not to miss. At the end of the video, I'm going to share my secret trick for quickly determining the true valuation of a pre-IPO company. Some small pre-IPO investments have turned into great fortunes. Naval Ravikant turned an early $100,000 investment in Uber into $100 million when the company went public. Chris Sacca made over $1 billion in just 6 years with a $250,000 investment in Twitter. There are many more stories of great fortunes being made from early investments in startups. But before you go and buy office space for your venture capital firm, there's one key requirement you need to meet. To make investments in pre-IPO companies, you will need to be what's known as an accredited investor. I'm going to explain what that is, and if you don't meet the requirements today, it will give you something to aim towards. So take the hot or not challenge, and let's see if you are an accredited investor or a court jester. In the United States, the Securities and Exchange Commission, or SEC, define the requirements. There are two ways to pass the test to be accredited. There's no literal test, you just need to meet one of these two requirements. You have to have earned income of at least $200,000, $300,000 if you're married, in each of the last 2 years and expect to earn the same or higher income in the current year. Or you must have a net worth of at least $1 million, excluding the value of your primary residence. If you meet one of these two requirements, you're likely thinking, cool, I'm an accredited investor. If you do not meet either of these requirements, you are likely thinking something like, this is dumb, this system's rigged, the rich get richer, life's not fair, and so on. There's a good reason the United States government does not want you investing in pre-IPO companies, but you might not like the answer. It's to protect you from yourself. That's right, you can't be trusted to decide whether or not investing your money in a pre-IPO company is a wise decision or not. How does the government know that you can't be trusted? Because you don't meet the requirements to be an accredited investor. Since you don't have $1 million or make over 200K per year, you likely shouldn't be investing in highly illiquid, risky pre-IPO shares. The rules are in place to protect you from losing access to money you may need or just flat out losing all your money. I personally have conflicted feelings about these rules, especially since I wanted to invest $50,000 in SpaceX back in 2015 when the valuation was only $12 billion, but was unable to do so because I was not an accredited investor at the time. I do understand the desire to protect people from themselves, and investing in pre-IPO shares is very different and more difficult than investing in publicly traded shares. However, just because somebody can't invest their entire life savings in a pre-IPO company does not mean that there are not a million other ways people could blow their savings. The government does not step in to stop you from investing in a meme stock, crypto, or sick rims for your new car. Even in the publicly traded markets, there is still the chance you invest in the next Enron or Virgin Galactic. Pre-IPO investments typically have a very high minimum investment requirement, and I would argue that the average American would likely end up better off tying up $25,000 in a good pre-IPO business than blowing it all on Twinkies and trips to Disneyland. In addition to high minimum investments, you also need to tie up your money for long periods of time. Until there is an opportunity to exit, you have very few options to sell your shares and will likely not be able to cash out at the current valuation. You need to wait until there is a liquidity event like the company being sold or doing an initial public offering before you can reap the rewards of your previously paper-only fortune. There's also the whole losing your entire investment thing to think about as well. We always hear about the success stories where a small investment turned into a great fortune, but we do not hear about the thousands of other pre-IPO investments that went up in smoke. When you invest in startups, you are choosing to lock up your money for a long period of time in a risky venture with zero guarantees of any return. This screen is the final thing you see before completing an investment on a popular pre-IPO investment platform. The investors who do well at this spread their risk across multiple startups. Even the most talented venture capitalists are unable to consistently pick winners. You invest in 10 companies expecting 9 to fail and praying one will succeed and make up for the other 9 terrible investments you made. This is how you go from an accredited investor to a decorated investor. Now, if you don't meet these requirements today, don't worry. There are some workarounds that will give you exposure to some of the hottest private companies without being an accredited investor. I'll be doing more videos on how unaccredited investors can still invest in hot pre-IPO companies like ByteDance, who created TikTok, Epic Games, the makers of Fortnite, and OpenAI, the creators of ChatGPT. Hit the subscribe button so you don't miss out. If you're an accredited investor, you are ready to invest, but how do you actually find and make an investment in pre-IPO companies? There are several options available, and they generally vary on the size of the company, what round of investment they're trying to raise, and how in demand their shares are. For small businesses, a friend or family member's business, or if you uncover the next big startup before venture capital firms, the best way to find out about investment opportunities is to just ask. Private companies cannot advertise their investment offerings, so opportunities to invest are generally found by word of mouth or simply reaching out and inquiring about making an investment. Another good resource for finding both early stage and later stage investments is AngelList, a website for startups seeking angel investors. The company was founded in 2010 by Naval Ravikant, one of the greatest angel investors of all time, who served as its CEO until 2015. Once you have an account, you can browse startups seeking investments, view their pitch decks and financial projections. If you invest, AngelList typically handles the legal and administrative aspects of the investment. If you're looking to invest in a more popular later stage startup and you are a large venture capital firm, financial firm, or have hundreds of millions of dollars available to invest, you might be able to invest directly in the company. But for those of us that are barely millionaires, getting access to shares in hot startups can be a bit more challenging and usually more expensive. The easiest way to get your hands on hot shares from companies like SpaceX, OpenAI, or Reddit is to buy employees' shares. Employees at these startups are typically granted options or stock that vests over a certain number of years. Just like investors, though, any wealth generated through these shares is just paper wealth until there's a liquidity event where the shares can be sold. For employees that need the money now or don't want to wait until their company is acquired or IPOs, their only option is to find a willing investor to buy their shares and take on the legal paperwork required for that transfer. To make the process easier, a number of pre-IPO platforms are available to match buyers with sellers and to take care of the paperwork. This is not a free service, and all these platforms charge fees, some much higher than others. EquityB is one of these platforms that facilitates these transactions. They usually have a good selection of big name startups available to invest in. However, the deal structure tends to be rather complicated, and the upside on your investment is usually capped. In addition to this structure, EquityB typically takes a fee of 5% upfront and a post-liquidity fee of 5%. EquityB is a very greedy bee and does not want to share its honey. Although they have some of the most attractive queen bees out of all the hives, the deals are not sweet enough for me. Microventures is another platform that provides investment opportunities in pre-IPO companies, both hot startups and smaller, lesser-known startups. Unlike EquityB, when you buy shares, you will actually own them, so you fully reap the rewards if the shares go to the moon. However, their fee structure is longer than a snake. There's a placement fee, a management fee, carried interest, and offering cost fees. I've saved the best platform for last. Founded in 2013, EquityZen offers free IPO shares in a wide range of well-known and up-and-coming startups. You might not always be able to find the hottest unicorn listed here, but if you are patient, they sometimes make a brief appearance. There are also plenty of well-known companies with lesser demand more readily available. The fee structure is a refreshingly simple upfront fee paid when you make the investment. The fee can vary, but it's typically 5%. You own the shares and all the upside when there's a liquidity event. It's getting late, and I promised a hot tip on determining accurate valuations for pre-IPO companies. Before making any investments, it's important to pay attention to the valuation a company has been given on these platforms. The valuation is based on what the platform thinks they can sell the shares for, not necessarily what the shares are worth. The platform will usually use the startup's previous investment round to determine what a fair valuation for a company is, but these can change quickly. Just because the company was valued at a certain price 6 months ago does not mean that that's what it's worth today. To get a ballpark estimate of the true valuation, you can compare the private company to a similar publicly traded one. Also use common sense and think about how the industry has performed overall. Think about what happened to similar publicly listed companies since the previous investment round. This will give you a rough feel for whether the valuation might be higher or lower than a startup's previous investment round, but it still won't give you a solid estimate, which brings me to my trick for quickly determining the valuation of a pre-IPO company. Fidelity is an investor in many of the hot pre-IPO startups, but unlike many of these startups, they don't just trust the paper value of the company and base their valuation off the previous investment round. Fidelity will increase or decrease the valuation of their holdings in a pre-IPO startup, and those calculations are performed by their highly compensated analysts whose sole job is determining the valuation of a company. Do they always get it right? No, but they are more likely to get the valuation right than you, or the startup founders and investors drunk on paper money. So when you're trying to determine an accurate valuation, see what percentage adjustments Fidelity last made on their investment and adjust up or down based on the last funding round's implied valuation. Investing in pre-IPO companies is a good example of the chicken or egg question. Do you get in early at a low valuation when there's little competition for shares and risk of failure is highest? Or do you wait until a startup is a high-flying unicorn risking lower returns and potentially not being able to find any shares? The first pre-IPO investment is the scariest because all your eggs are in one basket. But if you can push through and spread your risk, you'll be looking at the sunny side of life and might just get your golden egg. If you got any value from this video, hit the subscribe button for more great tips that just might make you rich.